Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for clicking. On this episode, we're going to be doing our monthly mortgage rate update. We're going to look at where interest rates were over the past few months, where they're headed right now, and what are some of the major reasons why those interest rates potentially had gone up. Stay tuned, you don't want to miss it. For those of you watching on the Santo Sessa YouTube real estate channel, once again, thank you for clicking and thank you for watching. Don't forget to leave your comments in the comment section below. Don't forget to hit that like button. And if you're not subscribed to the channel, we invite you to subscribe and hit that notification bell so you can stay up to date with what's happening on our Finance Friday episodes. And if you want to book a consultation with myself or Santo, you can definitely do that in the description box below. We'll make ourselves available to talk about mortgages and real estate or whatever's on your mind. But now, back to the video. As we kick off the month of June, it's time for our monthly mortgage rate update and seeing exactly where interest rates are as of the first week of June, where they were over the past few months, and what could be driving interest rates higher or lower in the coming days and weeks ahead. On this episode, I want to take an opportunity, just take a step back and look at what some of the things that happened in May that sort of potentially pushed interest rates up. As you may be aware, the 5-year Bank of Canada bond surged from a low of 2.75, 2.8%, all the way back up to 3.4, 3.5%, which is putting a lot of pressure on that 5-year fix. Remember, the barometer for 5-year fixed mortgages and most fixed rate mortgages are the Bank of Canada, the Government of Canada bonds, those debt instruments that are issued. So it is important to look at what is happening there. Now, why were these bond prices surging? What sort of happened when they were a lot lower? Interest rates have definitely changed, and you'll see that in the numbers in just a little bit. But obviously, there are some key catalysts. Obviously, inflation numbers came in hotter than expected for the month of April. So last month, we heard in May about April's CPI headline inflation that went from 4.3 to 4.4%. And although it is a marginal jump in the headline inflation number, which is obviously the key number, that's what the Bank of Canada wants to see, but how they make their decision is on the core numbers, what's happening in those particular buckets when it comes to food, fuel, heating, energy, all these other components. One important thing to pay close attention to was that 28% of that increase was caused by higher mortgage interest rate costs. Canadians paying more for obviously servicing those variable rate mortgages, Canadians that are renewing their potential mortgage in the coming months, weeks, years ahead. Obviously pointing to Canadians that maybe have been in a very low rate mortgage just a few years ago or got the mortgage maybe in 2020, and what will happen with that renewal in 2024, 2025, and 2026, depending on the term of the mortgage that they received. It is very challenging, though, to basically predict where interest rates will be that far out. And the Bank of Canada is sort of saying that when Canadians renew these mortgages at the higher cost, today and tomorrow, that there's going to be less disposable income in the economy, because if you're paying more for your mortgage, that means you have less to take home and spend elsewhere in the economy. So in essence, you're using inflation to fight inflation. And that directly comes from the pretty much the sentiment from the governor of the Bank of Canada when asked about mortgage cost and how it's helping to bring inflation down.
Another very important part is mortgage costs, and with interest rates having risen rapidly to control inflation, mortgage costs are up. I mean, that's an intended effect of monetary policy. That's how monetary policy works. That's how ultimately monetary policy will get inflation down. But obviously, it has some direct effects. So you have to look at the total effects of the increases in interest rates on housing, and I mean, the reality is, higher interest rates are working. Inflation is coming down. We're assessing whether we've increased them enough to get inflation back to target, but inflation has come down reasonably quickly so far.
So obviously that is important. Earlier this week, we got the economic numbers, those GDP numbers. The forecast was potentially for them to come in a lot lower, but they ended up going a lot higher. And this is something that's very important to keep in mind because, as we mentioned, inflation, economic performance, what's happening with employment, unemployment, are driving factors to the Bank of Canada's June 7th rate decision. Right after the June 7th rate decision, the next one will be in July, and then they'll break for the summer, and we'll hear back in September. So obviously there are a lot of things to consider. And as mentioned, we're going to get the inflation numbers for the month of June, hopefully we see those numbers tick back down. But it's important to look at, the base effect here when it comes to these interest rates, sorry, I should say inflation rates, because as you may recall, June, July of 2022 were some of the highest inflation numbers that we had. And as those numbers roll off the average, well, inflation should be coming down. And we hope to see that the Bank of Canada will potentially hold that pause. I know a lot of Canadians are anticipating either a pause or an increase in that policy rate. I think the probability or the percentages right now for Bank of Canada increase was around 65 to 70%, depending on what you're reading. Obviously, I think there's more of an upside that the Bank of Canada may potentially increase that policy rate just to ensure that they have inflation under control. Remember, Bank of Canada's mandate is to keep inflation at that target range of 1 to 3%. They want it back to 2%. But it also has an immense duty to ensure that there is stability in financial markets. Like we talked about, the FSR, Financial Stability Report, they need to make sure that the banks are liquid and credit is available. If we start to see a tightening on that, well, there's other problems, and looking at those lagging indicators, which we talk about, recessions, what's happening, so on and so forth. But we'll leave that for another video. If that's something that interests you, please do not be shy to hit the subscribe button, hit that notification bell, and don't forget to leave a comment below, share the video, like the video, and if you learned something, please share the video with somebody else, helping the YouTube algorithm. Now let's get into those interest rates right now. Before we jump into them, it's important to understand, for those of you that may be joining us for the first time, first of all, welcome. But interest rates right now are based on the insured, insurable, and conventional products. Now you may be asking, what is that? I'm looking to buy a home. I have no idea. Well, obviously an insured mortgage is for a purchase 25-year amortization. That means it cannot exceed 25 years. You can still have a term of 1 to 5 years. It is default insurance premium required, paid by the borrower. It's tacked onto the mortgage, and that purchase price cannot be higher than $1 million. It has to be below $1 million. And that's for those individuals that are putting less than 20% down. Now, let's say you want to put 20% down and you want a 25-year amortization, but you want to take advantage of some of the better rates, or you are in an existing mortgage right now and you're approaching renewal and you're not happy with your bank's offer. Well, you can do a switch transfer into an insurable product. They are not for refinances. These are all for purchases. So it's important to understand the requirements are, once again, that it is a 25-year amortization with an insurable mortgage if you're purchasing or you're switching into that particular product from an existing lender without refinancing. That means you're not changing the mortgage amount. Then you do not have to pay the default insurance premium that is absorbed by the bank, and rates can vary depending on the amount of equity or the down payment on that product. And finally, there's a conventional mortgage, which is a 30-year amortization. That means you can refinance, you can take equity out, or you can basically restructure that mortgage, consolidate some debt. You have an option to take up to 30 years on a new mortgage. There is no ceiling potentially on the purchase price. There are different parameters if you're going well over, let's say, $1.8 to $2 million as a purchase, but generally you can basically purchase for over $1 million. There is no default insurance premium on that product, but higher interest rates do apply because it is an uninsured or insurable product. It's not insured. So there is generally some higher costs associated with those mortgages. So let's get into those rates right now. Now that you're aware of what the differences are, we just basically stripped out the 1, 2, and 4-year products, as we will put a snapshot of the actual interest rates in the video at the end, so that you can see exactly, if you're not interested in 3 and a 5 and you want to know what the 1, 2, or 4-year is looking like and variables, well, we did put that in there. But let's take a look at what's happening now. So a 5-year insured mortgage kicked off in March around 4.64%, decreased in April to 4.49%, and came down even further in May, at the beginning of May, around 4.39%. Remember when we said those bonds were, those 5-year Bank of Canada bonds were around 2.7, 2.8%. So obviously the spread brought that to 4.39%. Give or take, there were some lenders that were a little bit more aggressive, some that were not, but that was some of the best rates that we saw in May. Now, obviously by the end of May, that changed. Into the beginning of June, we saw those rates jump up, and they're now sitting at a 4.84% for an insured 5-year product. That is a 45 basis point spread between May and June. Just for those of you that may not be aware, BPS or beeps is 1/100%. So that is to help you understand that's basically at 45 basis points, almost 0.5% difference in rate of change. Now, if you look at a 5-year conventional product, we started at 5.14% in March. That came down to around 5.09% in April, and it came down a little bit even more in May, at the beginning of May, at 4.94%. And then it started to tick upwards in June to 5.19%, basically a 0.25% jump from month to month. And the 3-year insured mortgages we saw kick off at 4.99, moved to 4.99, or actually stayed pretty static around 4.99. Some of them were about 5 or 10 basis points off, depending on the particular lender. And they were looking at around, May went up down to about 4.89%, and then ticked up to 5.24% in the month of June. That's a 35 basis point spread between the 2 months. And then your 3-year conventional, that is a lot of clients looking at this particular product, whether refinancing or restructuring. It has been a very popular product, was around 5.14% in March, down to 5.04% in April, and down a little bit more in May to 4.99%. And it shot back up to 5.39% in June, and that's another 45 basis point spread. So as you can see, for the month of June, there has been definitely some movement in these rates, and some of the things that we talked about that drove rates up in May could be a major factor. Did we miss something? Is there anything else that could have pushed these rates higher that maybe we didn't talk about in this episode? I want to hear from you, our viewers. Let us know what you think in the comment section below. Here we'll put in the snapshot of what is happening with interest rates right now. Maybe you're looking at a 1, 2, or 4-year product. Maybe you're looking at a variable, obviously depending on insurable products. Here's a little bit more of a range of what's being offered today. And keeping in mind, if you're new to the channel or if you're an existing subscriber to the channel, thank you again. But we do have in the description box below a link to our mortgage app that can help many Canadians understand what rates are looking like today, what those rates mean when it comes to real mortgage payments. We have refinance calculators, you have purchase calculators, you have comparisons side by side, you have income calculator, and even refinance calculators in that app. It is all free for you to download in the description box below. But we'll leave the video here, wishing everyone a fantastic and wonderful weekend ahead, enjoying the sunshine, and we'll see you next week. Thanks for clicking, thanks for watching.